Organic Talk is back, which means it's my time to shine. If you don't know who I am, my name is Kenneth Suna. I am a fully self-taught investor and stock trader. I've been investing for 20 years and trading stocks for the last 14 years. And like I said, fully self-taught. I wanted to be a professional wrestler. This was me when I was 18. This is me at 39. I've been investing and trading and teaching myself all along the way. And I know some people might watch a video on my channel and go, well, why would I listen to you? You're self-taught. The point is to say, anyone can do it. Even me. I failed math all the way through high school. Wasn't a good student. Didn't go to college. And I taught myself. So if I can do it, you can do it. And I know a lot of people are really stressing right now. It's going viral all over TikTok. Every other video on my For You page is sell everything, oh no. And people who are in their 20s and 30s are going, okay, relax. Just relax. If you are 20 or 30 years from retirement, you don't need to do anything. Now, I'm getting a lot of comments from people saying, I'm retired and I'm in 100% growth stocks. If you're new here, we talk about this all the time. As you get closer to retirement, you need to do something called rebalancing your portfolio. There's an old adage on Wall Street, which is invest your age in bonds. I don't think this is really all that important if you're in your 20s or 30s. For example, I'm 39, I've got 0 bonds. But as you get closer to retirement, so if you want to retire at, say, 60, when you are 50, you don't immediately, but you start rebalancing away from high growth and into stuff like bonds, which are generally seen as safer, or high quality dividend ETFs, which are generally seen as safer. You don't want to be 100% in stocks, because when growth stocks get crushed in recessions, it takes years, potentially, for them to recover, which if you're 20 or 30 or even 40, well, who cares? You've got still years before you retire. But if you're 59 and all of a sudden something happens and you're like scrambling, no. See, the benefit of bonds and high quality dividends is that they're seen as a little bit safer of an investment. The idea here with investing over a lifetime is maybe you start when you're 20, and by the time you're 50, you've been investing for 30 years. Now you can start to rebalance into some safer things because ideally, hopefully at least, you've made the majority of your money. And now you want to protect the majority of your money by having it in stuff like bonds. The objective doesn't become, I need to make more. The objective needs to be, I need to preserve the majority of my money. It doesn't mean that you have 100% stocks and then you go from that to 0% stocks. It means you start rebalancing. And of course, it's different for every single investor. And you've got options. If you have a 401k from your employer, usually the top option is something called a target date fund, which means you say, okay, I want to retire in 2055. And as you get closer to that retirement, it rebalances for you. So you don't have to do a whole lot. There are all kinds of target date funds. I'm going to show you a few just as a quick example. So this is one from T. Rowe Price. And as you can see, in the last 10 years, it's up 52%, which is not great. And it also has a pretty high expense ratio. This is the fee. It's not super high. Anything over 1% is generally considered to be pretty high, but this is still pretty high. And if you click right here on holdings, it will show you what this fund invests in. And this is another option from Vanguard. And you can see over the last 10 years that this one is up a little bit more, 78%. And look at this. The expense ratios are much less. Their total holdings include stuff like total market, total international, and some bonds. And you might notice that these target date funds don't go up as much as the overall markets. And that's because they have a lot of exposure to bonds, even early on, which means I'm not the biggest target date fund fan. I'd rather just do it myself. Target date funds are easy because they do everything for you. The downside of target date funds is, like you saw, they can have higher fees and wildly underperform the overall markets, which means you'd probably be better off just picking your own stuff in your 401k and your Roth IRA and your individual account. If you have a 401k, you should still have the other 2 accounts. You want as many tax sheltered options as possible, like 401k and IRAs, but you also want your individual account because, hey, let's face it, you don't want to work forever. Maybe you want to retire when you're 45, 49, 51. You don't want to wait till you're 60. In that case, you'd go to a brokerage like Charles Schwab. You'd scroll all the way over here to open an account, and you would open 2. You would open an individual brokerage account and a Roth IRA. This is depending on your income. If you make a lot of money, then you'd get a traditional IRA. This is not financial advice, but this is exactly what I would do. In my 401k, I would pick, whatever they offered that I could do on my own, like an S&P 500 index fund. In my Roth IRA, I would pick a technology-heavy ETF. This one, as you can see, holds companies like this. You recognize, I'm sure, a lot of these. And if you look at their 10-year performance, this fund is up 484% in the last decade. If you're trying to avoid a big tax bill in retirement, you would want to avoid this way before you would want to avoid something like SPLG, which is an S&P 500 index fund, which is up 192%. I would put this in my individual account. And I'd also put something like a dividend ETF like SCHD, which is only up 108%, also in my individual account. That means, yes, you will pay taxes on dividends. Who cares? It means, yes, you will pay taxes on any profits you take. Who cares? This is just one example. Your individual risk tolerance and goals and all of that are different from person to person. Again, so broad, sweeping example. From 20 to 40 years old, 50% FTech, 30% SPLG, 20% dividends. When you are 40 to 50, you start trimming back on the growth, but just a little bit. 40% FTech, 30% SPLG, 20% SCHD, and 10% bonds. So you're adding in a little bit of stability and insulation in your portfolio. And once you are over 50, 20% FTech, 20% SPLG, 30% dividend, and 30% bonds. And as you get older, you want that bond number to increase. Rebalancing is a strategy. It takes time. You don't want to be a week away from retirement going, oh my God, what do I do? Or 65 years old going, uh-oh. All right. I hope this video helps. If you're new to investing, make sure you smash that follow. I'm here to help. Everything that I offer here is 100% free. Let me just quickly show you. I know I'm talking a lot, but there's a lot of useful information here. So all you got to do is go right here, click on the menu, which is right here, and all of this is 100% free, including my resource guide, my course, my templates, all free, no email sign up.